Hey Internet, it's RJ. Welcome back. Thanks for tuning into the show today. Now, today's episode, we're talking about the holy grail, the last frontier, we believe, of credit cards. And that is being able to pay your mortgage with a credit card. We've seen the BILT rewards do it for rent, so it stands to reason. The last frontier is mortgages, which would be great. But BILT's had some issues with their current partner, Wells Fargo. So how does that play into all this? Why can't we do it? Why hasn't anyone done it yet? That's what we're going to talk about. So, of course, if it sounds interesting to you, then go ahead, press the subscribe button, and let's get to work. So what originally brought on this thought process was, if you follow the show or the news at all, a while back, Wells Fargo and BILT Rewards were in the news because the Wall Street Journal had a report out that saying, again, Wells Fargo being the lender or the issuer behind the BILT card was actually burning through $10 million a month trying to support this partnership and the product line. And so that's not awesome, and it doesn't mean, good things for, the next evolution, which would be mortgages. So, I mean, long story short, if you go into the BILT partnership, it's, again, BILT's a card that allows you to pay rent with a credit card, which you can do today if you have a large enough, property management company or something like that, except you get hit with that 3% processing fee, which is no good. That kind of ruins the whole thing. Sure, if you're chasing intro offers, then yeah, fine. But aside from that, no, not just on a regular daily basis. But the good part again, the BILT card doesn't charge the customer, the end user, the 3%. But it's not free, despite what someone would have you say. There's nothing free, and so someone has to pay the 3%. So that was Wells Fargo paying the 3%, at least at the time of taping. They also kind of messed up their customer projections, in my opinion. But again, that's been all documented, talked about. So the overall, again, thought concept was, like, if they messing it up and losing money on rent, what does that mean for the mortgage space? Well, it'd be the same concept, right? You have a payment you want to make, and someone has to handle the 3% fee, and like that seems on the surface the answer. People don't do it because it's 3%. Someone's got to pay it, but that's too easy of an answer. We're going to go a little bit deeper than that. Just like they do on Wells Fargo and BILT. BILT kind of gets a pass because it's not technically paying debt, and the debt thing does get a little bit tricky, as we'll talk about. But first, let's talk about the 3% fee, right? So yes, on the surface, as Wells Fargo's learning, 3% adds up, 3% isn't free. And of course, in this scenario, no bank or issuer or servicer wants to pay the 3%, so they just don't do it. But again, a little bit deeper than that. So we have to understand mortgage servicing a little bit to get a better, fuller understanding of the answer and why I don't think it's gonna happen. So I've never worked directly in mortgage servicing, but when I was at an old bank that's since been bought and closed, MB Financial, we did have a servicing arm. We had a servicing arm when I was at Rocket too. But I used to go down to Wilmington, Ohio to mortgage servicing and like help out on projects and stuff like that. And so what mortgage servicing is, in case maybe you haven't bought a home or anything yet, is, of course, the lender's going to write a loan. You're going to buy a house for 100 grand. They're going to say, great, here's your 100 grand. They're going to fund it now. So you owe the bank 100 grand. You can only do this so many times before you run out of money. So to get their money back and their profit quicker versus waiting to the term of 30 years, again assuming this loan lasts for the full term, right, of 30 years, they buy them, they write the loans, fund them, and then they turn around and sell them within like days of closing, if that, sometimes 2 or 3 days. They sell them on the secondary market. You securitize them. You bundle them up. That's how you get the term mortgage-backed security. Package them up, sell them to an investor. Let's make it easy. Let's just say you got Freddie and Fannie. They're the biggest purchasers of, those type of conventional loans, right? Easy enough, right? So then the lender gets their money back plus their margin on top, and they can continue the lending process. Pretty cool. But when you've sold a loan, yes, that Freddie and Fannie, they own the loan. There's still things that have to be done to that loan through the life of the loan. They have to make sure your property taxes are paid, make sure your homeowner's insurance is paid. The only thing that will beat out a lender and their having lien position is Mother Nature and Uncle Sam. So they got to make sure those two things are paid no matter what. If things go poorly, you got to make sure they do follow the processes to kick you out. We don't really want to kick you out, but you get the point. And to our point, you got to collect and distribute the payments, right? So that's where mortgage servicing rights come into play. Who's going to do all that stuff? So I could buy a loan, and then I can say, but I don't want to do all that. So I'm going to sell the servicing rights to an actual mortgage servicer. It's entirely possible the lender offers a servicing division and keeps their servicing. Again, MB Financial service loans, Rocket Mortgage, where I also work, service loans. So that could take care of itself. The thing about it is generally they're using these larger service companies because you go to Wilmington, Ohio to set up your servicing shop because it's not a margin play, it's a volume play. You're making very little amount of money on each one, but it's for the most part a scalable process. And if nothing goes wrong, then it's fine. Like you really don't want to go into REO, which is real estate owned foreclosure. Like nothing about servicing or banks are set up to own and maintain properties, right? So that's another side. But for overall, for our purposes, that's mortgage servicing, which means that someone's got to manage those payments. And if you're trying to make a scalable process, especially if you're not the actual lender, you have no real vested interest in like customer retention from the borrower side, right? Because technically my customer is the person who sold me the servicing rights. So I don't really care. There's no win in it for me to start accepting credit card payments. Number two, there's all the things that come with it. I have to set it up, right? I have to train people. I have to get the hardware in here to accept payments, put it online, what have you. Chargebacks. Chargebacks are a very real thing. I got to worry about chargebacks now. We know this stuff happens all the time. There's other things, there's other rules and conditions that come with credit cards. It's more information that you have to store and handle securely. It doesn't happen, and that's a lot to ask of someone who's trying to do this as cheaply as possible, who has no real vested interest in the actual borrower. Sure, they want to keep them happy because, if you get enough complaints, I guess, you would want to, no longer use that servicer as a vendor, perhaps, but it's going to take a lot to actually come to that. So, that when you understand mortgage servicing a little bit better, now we understand why that 3% is a bit much. The other thing is, aside from most banks not wanting you to pay debt with debt, that because I don't actually think it's more risky than people say it is, but technically we are introducing a choice, right? So if you're paying debt for debt, it's entirely possible that you don't have the money to pay it, and you're kind of delaying foreclosure or forbearance or things like that. And as you keep doing it, eventually you will have a choice. Either I continue to pay the mortgage, I pay the credit card bill, I pay whatever else. So it's a perceived risk, and that brings us to our other point, which is I think you'd have to disclose it to the investors, to the people buying the loans. I feel like you'd have to get their sign off on it. I don't know this part for fact. The other stuff I'm like 99% sure on. This part I'm making an assumption that because in banking I can, even if things don't sound risky or any more risk, it's all about like market price plus risk. That's how you get product pricing and everything. So I can say, well, hey, that's more risky because you literally don't have the money. If you're using a credit card, as soon as you swipe your Amex, you're now in debt to me still and American Express. Whether you intend to pay it back at the end of the month or not doesn't matter. It's still, that's objectively, that's how it works. So I feel like if you're going to start taking credit card payments, you'd have to go get the investors' approval on that. And again, if you go back to Freddie and Fannie being the largest purchasers of loans, what happens is, if you ever heard the term, like, I have underwriting conditions on a file, right? What happens is you go to your bank and they say, okay, yep, we run your initial information, your vitals as we used to call them, and they're going to upload your file to Freddie or Fannie, which was like Loan Prospector or Desktop Underwriter back when I was there. I don't know if it's still the same or not. I haven't been directly in mortgage in a while now, but they have those. And basically what their Freddie and Fannie's computer system do, they come back and they say, yep, if this loan were to meet all these criteria, then I would likely buy it. And the criteria will be like appraisal supporting value, W-2s, paycheck, verification of employment, all those things that become your checklist through the mortgage process that you have to do. And those are called, their conditions. So, if you wanted to go back and add another one and say, well, they're going to be paying by credit card, that's how they're going to receive payment, I feel like that's going to add another layer of potential risk to these guys probably just don't want to deal with, because again, it's perceived as less risky if, you just give me your bank account information, and more often than not, I can just go as a servicer again and pull the money out. Sure, you can also initiate payments on your end, but generally they want you to set up auto pay and do all that again with a credit card. You're almost a little bit more protected, I guess. And I think that adds another layer of risk. Again, I don't think it's super risky because it's, conventional underwriting is generally only good for a year anyways. After that, who knows? You get fired, lose your job, move jobs, who really knows? But I think that's another component of it. You actually have to get the investors' approval. So if you take into effect all of that, it doesn't really seem enticing or even really worth it for a bank to do this on any level. Now, let alone the fact that a lot of banks don't really love writing mortgages as much. A lot of them stayed in the mortgage game because their customers didn't want to go to other institutions. Like, hey, I already bank with you. I don't want to go learn someone else. I just want to get I have Bank of America checking. I want to get a Bank of America loan. When I was in the title game, we lost a few of our main clients, like Citi pulled out because they're like, we're just not writing loans anymore. Even Wells Fargo has kind of scaled back on their mortgage division from what I've read. So you're really left down to these lender first people like a Rocket, like a Guaranteed Rate, people like that who specialize in writing mortgages. So, like, who is the closest to making this happen? Well, I kind of lost hope for it, sadly. Again, Rocket being one of my alma maters, and again, they threw me out, but I still originate with them, and I have the Rocket card. When the Rocket credit card came out, we could kind of see where their priorities lie, because you use it, and they're like, yes, we'll give you 5% back if you redeem your points for a new origination, only a new purchase origination too, not a refinance, anything like that. If you send the money to the, as a principal curtailment, like to your balance, it only cashes out a 2% rate. So they were the ones who I thought like, oh, we could actually go for it and do it. But when they stayed away from being able to pay it with a credit card, or even being able to earn 5% back on the card and then redeem it towards your principal balance, even if they capped it, I think that not being able to do that also probably would have to be run by investors if you're introducing another way that customers can pay off their loan faster, right? Because again, investors, they're making their money, that interest payment is kind of like divvied up, right? There's the interest to the financing piece, but then that's kind of what the investor gets. Again, some of it sure takes care of the servicing, but you get the point. So if I'm giving you an easier way to pay potentially, or double pay, depending how you want to look at it, right? I should probably have to tell the investor that of like, well, these loans could potentially be accelerated payments because I'm giving them another way to pay it off, another form of approval that I think you would have to get. At least I'm pretty sure you would. I don't think you could just blatantly do it one day, like no big deal. So that's a lot of factors in there to say, because the way the system is set up, because of the requirements of credit cards, because of the processing fees, because of the scalability and wanting to run it at lowest margin or low cost as possible. There's really, to me, there doesn't seem to be an upside to anyone to do this on the banking side, on the servicing side, on the lending side. Customer side, sure. But again, I just got you for 30 years. Sure, no one really pays for 30 years. It's usually, I think it was like 7 or 8 years was like the average back in the day for how long loans last. I don't know what it is now, but you kind of see the point. Like, it's not really a benefit for anyone to do this. And, I think that also speaks to the BILT card a little bit. Like, it's not exactly the hardest thing to replicate from a large financial institution, but we haven't really seen anyone try to replicate it yet, and it's been around for a while. So either people are kind of laying out and say, let me wait and see how this plays out, or what. I think it makes much more sense to continue on the BILT relationship if you're Wells Fargo and try to convert that into a feeder system into mortgage, where you can make much more on originations. There's just more fees and things like that. Balances are usually higher, so your origination fee is higher versus a refinance where you've been paying it down, so it's a little bit lower. To do that and to do cross-sell products. But once I have you in the mortgage, I just don't know that it's really worth anyone's time and effort to stand this up. As much as I would love for it to happen, again, 3 mortgages, there's just not even a way where you wouldn't start to lose your shirt on these points, let alone the fact that we've seen the BILT cards. One of its Achilles heels from BILT's perspective is that 5 transaction per month that you have to do. People are just doing Amazon reload. So, this is only going to this will attract some average people, sure, but this is mainly going to attract people who know what they're doing and have higher tolerance for paying debt for debt, doing their transactions to keep the card open. I think that's kind of BILT's downfall, but I think they can work around it and come back. Is where mortgage, again, I would love to see it. I just, for all the reasons we outlined, I don't think it's going to happen, because I just don't think it's necessary, even if I really wanted to. But of course, let me know what you think down below. I would love to hear your thoughts on all of it, what you're hoping for. What do you think? Give me the play, give me the thing I missed, make it work, make it make sense. I would love nothing more than it to make sense as a person in the real estate game myself. Anyways, guys, that's going to do it for this one. So, of course, if you liked it, drop me a thumbs up down below. If you find it particularly interesting, consider subscribing to the channel, as we're posting content just like this every single week. And, of course, right back here every Sunday with all the news you can use in the week that was in credit and finance. And, of course, every single day over on ProfitableContent.com. The channel's blog, always linked down below for you. We have the latest news stories. We have bank promotions, and we have credit cards. Can't use any of them for the mortgage, but you can use them everywhere else, and that's got to count for something. Anyways, guys, that's going to do it for this one. As always, thanks so much for watching. I'll talk to you very soon in the next one.